Welcome to the Real Estate Development Land to Legacy podcast, the ultimate resource for aspiring real estate developers and enthusiasts. I'm Eugene Gershman, real estate developer and builder. Each episode, we dive deep into the journeys of industry leaders, uncovering their wisdom, successes, and lessons learned from their challenges.
Real estate development. Real estate development. Land to legacy.
And now introducing Jim Manning, an accomplished entrepreneur and real estate expert. He has initiated 2 real estate funds and successfully closed over 3,500 deals. Jim has grown businesses into multi-million-dollar organizations on 3 occasions and has set up 4 out of his 5 ventures to run autonomously. His expertise in real estate investing and scaling organizations makes him an invaluable resource for our listeners here. Jim, welcome.
Thanks, Eugene, for having me. I'm so excited to be here. Life is good. Investing is good. For all of you guys listening in, Eugene's a wealth of knowledge. He's been doing this a while with his family business. I appreciate you guys tuning in, and hopefully I can share something valuable today. That'll be the goal.
Excellent. Thank you,
Yeah.
Jim. So, how did you get into it? What drove you to real estate?
Oh yeah, so I had a experience out of college. I had an internship for a self-made billionaire. And the billionaire, what I was doing for him was inventorying his wine collection. Just to give you guys an insight into how much wine this guy had, at one point I had over $100,000 of wine in my hands. And it took 3 guys 2 full weeks to inventory the amount of wine that this guy had. And what was cool about that experience was he was a self made guy. And I got to meet him. I got to shake his hand. I got to see that, man, this is just a person putting on one pant leg at a time. I mean, if he can do it, what a great country America is. Why can't I do it? And so that was the day that, there's a little saying I say sometimes that, does a fish know what's in water? And I think in America, a lot of times we're in this amazing environment of opportunities. And sometimes we forget that these opportunities exist. So that was the day this fish realized that there was water. I learned a lot of important lessons through that experience, but the belief I think was one of the most important parts to it. Then I just knew I kind of needed to do my own thing. I wanted to go after the opportunities of starting my own business. I stumbled into real estate investing. And what I loved about the idea of a property flip was I could buy a neglected property that wasn't in good enough condition for someone to live in. I could invest into it and improve it and literally create a home for a family that they're going to have a lot of great memories on. If I get really good at it, I can make a lot of money doing it. So you call me like a pragmatic altruist that, I kind of went after something that I could make good money on and something that was an important service for the community at the same time.
Excellent, excellent. So,
Yeah.
yeah, it's a rewarding feeling when you finish. We mostly build residential, single family or multifamily, and when you see people live in these buildings that we've finished, it's always the most rewarding feeling.
That's right. That's right. And yeah, so got into, so started out doing one deal at a time. And I was working with a private individual that was lending me money to do the deals. So I like to call them private lenders. It's a high net worth person that has capital, but they don't necessarily have time. They like the idea of investing in real estate, but they want someone else to do all the work. So we had a one money partner, and we're able to build up with that one money partner to doing 3 flips at a time. But what we were doing was we were putting our own capital into the repairs. So we get 100% loan on the purchase, but then out of pocket, my partner Ryan Wessels and I were paying out of pocket for the repair money. And then we realized, well, wait, this person trusts us. Maybe they'll pay 100% of everything. We talked to them. They said, yeah, well, you guys have always paid me for the last couple of years. I would lend you everything. I think that trust is established. So we changed our private lending model to doing 100% of the purchase and the fix ups. And what happened when we made that pivot was now we weren't restricted by the amount of deals we could do, wasn't restricted by the amount of money that we had. It was only restricted by the amount of capital we could raise. Okay. And so then ups and downs have happened along the way, but you fast forward to, I don't know, it was 2018 or 2019. I think we owned 250 houses at the same time that we were flipping. And, now we have in the two real estate funds, we have 130 partners in them. The one fund buys and holds on to real estate and generates passive income that way. And then the other fund generates passive income through private lending. It's been a really rewarding ride. And that's a step that I think a lot of people miss. Like when you're just first starting out, I do think that you should get very clear on who you are. And what I mean by that is, are you a money partner or are you a hustle partner? Like, do you have time? And are you really wanting to get in and kind of get your hands dirty? Do you have professional skills? Like, do you know how to value a property? Do you know how to find it? Do you know how to negotiate it? Do you know how to find and manage the contractors? Do you know all of the pieces to the puzzle? You may not be like an expert at any of it if you're just starting out. I know I wasn't when I was 20. I didn't have money, but I had the time and I had the motivation to really hustle, right?
Mhm.
Or are you a money person? Maybe you're at corporate America or a doctor or something like that that's making great income and has capital to invest, but you don't have hardly any time to do it. And when it comes to passive income, guys, we all fall in love with the thought of investing in real estate because of that. Like, man, it's a path to financial freedom. It's a path to making really good money as an investor. The issue with that, though, is that passive income's a lie, and it's true. Well, wait, what
What
do
do
you
you mean?
mean? Yeah, what do I mean by that? So, if you're investing in real estate for the passive income and you're the one doing the work, you find the property, you repair it, you hire the right property manager, you fire the right property manager that became the wrong one. You started a recurring revenue model business, not a passive income. So, to me, passive income is I get to sit on the couch, put up my feet, and I got mailbox money coming in every month. Well, if you're the one actively doing the deals, that doesn't exist. Now, here's the cool part though. Just because that part of it's not passive doesn't mean you can't make it passive. So there is one way and only one way that I know of to make real estate passive, and that's finding the right who that's delegating all of the work to somebody else. So there's real estate fund structures out there now that you can utilize to invest into companies, or you can find private individuals too. Like it doesn't have to be a fun, fancy fund structure, but you can, if you find the right other person to do all the work for you, that person can turn your investment into a passive one. But it's not because there isn't any work in real estate. There's a lot of work that goes into real estate and to professionally do it. It's just that you don't have to be the one that does it. You can. So anyway, like when you're first starting out, the step that I think like almost everybody skips is, okay, I study it. I learn how to do it a little bit, study some courses online, some YouTube videos and everything. I feel like I know it a little bit, and I've fallen in love with the numbers and the potential of financial freedom. But then you skip that step of, well, who am I really? There's a lot of doctors I talk to, a lot of programmers that love the numbers, have the income, can afford to buy the properties, but don't have the professional skills to value a property properly, to manage contractors. What I'd like those people to know and understand is that's great. You can still invest in real estate and you don't ever have to know how to do any of that. You can leverage other people's knowledge and resources to do that because the money that you have is a very valuable thing for a partnership. You just need to think a little bit differently about it, and then learn how to be a passive investor and how to make prudent investment decisions, then let that allow you to have other people do the work.
Right. And what you were saying, Jim, applies to both developing properties from scratch or acquiring new properties and managing existing properties. What a lot of people do not recognize is it's not terribly hard to do it. Yes, it takes experience. So you do need to know a lot about it, but anybody could learn that. Certainly, doctors or software engineers can figure it out. But then the question is, do you
Yeah.
want to have that second job? Because it does become a second job at that point.
Yeah.
Or do
Yeah.
you align yourself with somebody else who can
Yeah.
do it?
Yeah, let's just not
Like,
be naive about it, guys. Let's be realistic with the decisions that you're making. I might be sounding negative about all that goes into real estate investing. I'm the hustle guy. I'm the guy that put in 50 plus hours a week for over a decade. You know what I mean? I've worked my tail off to get to where I am. And I wasn't the money guy. Now I'm both. I do both now at the stage of my career where I'm at now, but just know who you are and know what you want. But both are great. Both are valuable. Both are necessary. Right. And I mean, the interesting thing, like I talked about the billionaire, by the way, Eugene, and I did leave out one part of the story. So as I was hanging out with the guy, we were at his house with his wine collection. The first week, he would take us out to fancy dinners. Everybody knew him at the restaurant. All smiles, all jokes, all drinks. He had a girlfriend that was like a model gorgeous, and this guy was in his 60s, wider than tall. So, and I'm 22, just fresh out of college. I guess I had just turned 22. And I started to idolize this guy, like, whoa, this is pretty amazing. And so that was the first week, but I was with them for 2 weeks. And whether you're with somebody for 2 weeks and their personal residence, like the surface level stuff starts to go away and then the actual stuff starts to pop up. And what I realized about them was this is one of the most miserable human beings I've ever met in my life.
Hmm.
And here's a guy that has everything, but he gave up everything to get it.
Right.
And so one of the guiding principles of my life as I started out as an entrepreneur was that I made a decision before I started that I'm going to measure my success by what I gave up to get it. And to me, I don't care. There's no net worth that's worth losing my family over going after it. Right. So when we make our decisions, the message that I'd like you all to hear is that you can become financially free and not lose your family. You can invest into real estate if you have a very demanding job that's making you great money and you have that, man, I'll be happy if I get to this financial freedom and then I'll have more time for my family and everything like that. Well, what if there's a different path? What if there's a way to generate all of the investment benefits without any of the extra work? So then you don't have to spend nights and weekends rehabbing a house. You can spend nights and weekends with your family and still get the long-term benefits and, still build passive income. And I think it's just an important conversation to have and to raise the awareness level of everyone to think through that before you get started and know what decisions you're making and how they can impact your family. And
Mm,
yeah, go ahead. Sorry.
I was just going to repeat what you said, to measure success by what you have to give up. I think that's a very important message.
That's right. And so, yeah, so Passive Wealth Show is the name of my podcast. And I get really passionate about that and trying to get this message out. And I think if we're not careful, the desire, that's a good one, by the way, can end up being the most important thing when it shouldn't be the most important thing,
Very true.
in my opinion.
Presumably, you know a lot about underwriting deals and knowing what's important, what to look for. How do you explain to your investors what it is that you do to make sure that the projects you decide to invest into are the best choices? What metrics are you considering? How do you get it done?
Purchase strategy where people buy or owner by contract and they act as the homeowners on those deals. So for the loans that we do, when we are working with third party investors, we'll lend money at 70% of the loan to value. So we'll do an underwrite. So if the home's worth $100,000 after it's fixed up, the most amount of money we would give somebody would be $70,000. So if they come to us and say, I need $50,000 of purchase price and I need $30,000 of repairs, so I need $80,000 total, we'll say, well, you have to figure, if you still want to do the deal, you have to figure out the 10,000 on your own out of pocket because we're only going to give you 70,000 for this deal. When you get good on the underwriting and then the disbursement process, where you only pay for repairs that have actually been done, you dramatically lower the risk profile. In our case, depending on the year, it's been 1 to 3% of our loans end up getting foreclosed on. The majority of the time, we end up making some money on those because of that risk mitigation on doing the 70% loan to value. There have been some times where we've lost a little or broken even, though.
Is it concerning for you if, let's say, you're financing 70% of that project cost and they need to come up with the remaining 30? If they end up borrowing the remaining 30 from somewhere else, would that be a concern for you, or do you require them to actually
Yeah,
have
no,
more?
we would not be okay with that. That's
Why
right.
not?
For one, if they're getting into it for 100 and it's only worth 100, like, what are they doing? That's not somebody I want to work with. You got to have some profit baked in. I want to work for free, right? So I would be questioning their acumen there. But then if you're in first lien holder position, to have somebody else in second lien holder position, it just complicates the deal. Sometimes it's easier to keep it simple. So yeah, we would definitely highly prefer to
Mhm.
not have to deal with that on a foreclosure situation, because then you got a whole nother party to deal with.
Right, right. Yeah, that makes sense. What are the interest rates that you're charging?
Uh, so I can tell you what we charge, like the from the hard money lending company, the end investor. Uh, SEC rules and regs, like I have to be kind of guarded on what the returns the limited partners get. The reason they really want you, like if you're making an alternative investment, like investing into our fund, what the SEC's heart behind it and logic behind it's pretty solid. They really want you to be in a relationship with the person you're investing with and get to know them. So I have to be a little bit guarded there on that piece. It's a little bit annoying. I'd rather just tell everybody up front and not have to talk to people about it. We charge depending on the borrower. What we may charge 3 points and 13%, all the way up to maybe 20% and 5 points. It just depends on the profile of the borrower and what risk what the deal is, and
Mhm.
what we're willing to take on. But yeah, that's kind of like the normal range. Most of the deals are done at the 13 and 3.
Got it. And so the investors then into your fund, they get, is it a fixed rate or
Yeah, yeah, so they get less than that, and then the profit we make is we're the middleman doing all the work, right? And so we're
Mhm.
making the difference there. And then, yeah, they get a percentage, and that's private lending is really an amazing thing because, like, if someone has a high enough net worth and they want income from real estate, don't want to do any of the work, if you have enough zeros to invest, you can completely replace your income with enough zeros to invest in a private lending strategy. Like you can
Mhm.
literally become financially free in a couple hours, which is crazy to think about because normally you'd have to find a deal, get a tenant in there, and then try and cash flow it. And then depending on how the property performs or not performs, there might be some ebbs and flows in the passive income. But the debt strategy is really powerful because it's a promised return. There's not as much volatility behind it. And I am a big income guy. I believe in income as part of the investment strategy, and I think it's really valuable because income will put food in your mouth. Income will put fuel in your car. But net worth really just fuels the ego if you think about it. Say, "Oh, well, I have $20 million in the stock market." Well, that's fantastic, but what utility does that have for you? Well, I can get a
Right.
margin loan and I can do all this. I understand that. There's nothing wrong with the stock market. It's made a lot of people a lot of money and will continue to do that. But I think having some diversification out of the stock market and having some income coming in, especially as you gear up for retirement, is really powerful.
Right. Is there any capital appreciation at all?
Our debt model is just strictly what the percentage is, yeah. So in our
Mhm.
equity model, that's really where you get long-term appreciation benefits, and I mean, the trade-off with debt to equity, debt typically is less returns and it's less volatility, and
Mhm.
when done properly is less risk than equity. You just have to there's nuances because, like, you can lend money on anything. You can lend money on equipment, and you can lend money on, I don't know, payday loans, like, for example, right? Like, so, like, there's all different utilities on it, but the way we do it is a very low risk profile because it's backed, we get a first lien on an asset like that's backed by real estate, and
Mhm.
so it can be really low. But then on the equity side, what you give up though on the debt is if the investor buys a property right and they're going to make 200 grand on this just crazy killer deal, Well, the loan on that deal is incredibly safe, right? Because they have that much equity built in. So you're for sure getting what you were promised, but you don't necessarily get any of that upside.
And so how does the equity fund work?
Yeah, so the equity fund, how they work is you basically get a group of people together. So in our case, and the one that we just closed out, there's about 65. I there might be 67. It's ebbed and flowed on it, and I haven't. I just realized I think there's been a couple people have came in since I last checked that stat. But anyway, there's a group of people together, no matter how many it is. It might be five, it might be 100 people or 1,000 people, right? And then you just get an ownership unit into the fund, and then you go out and buy real estate with it. And a fund structure is you buy multiple pieces of real estate. There's also syndication structures where you have one deal and multiple people that invest in that one deal. In a fund structure, you have multiple people that invest into multiple properties together, and that same entity owns all of those properties.
Gotcha.
Yep.
Gotcha. I'm sure you've had some horror stories. Can you share one?
Into a home run that start out a horror story. Maybe I'll just share. There's been other ones that started out a turd and ended a turd, but uh, it's just the one that popped up. So anyway, we bought a property that we're gonna flip, and it was a 700 kind of $1,000 price point, which in St. Louis City is like kind of a little mini mansion, like a really beautiful home in the city. The land's a little bit less expensive than in parts of the county, and so then we put it on the market. We were excited we're going to make all this money, and then the thing just sat. And then we lowered the price, still not selling it, lowered the price, and then it got to where we are going to break even on the deal. And at that time, we were looking at it and we're like, gosh, it's across the street from a park. This is just a beautiful piece of real estate. Like, do we really want to let go of a quality piece of real estate like that at a break even price? And geez, if we had to lower it again, we're going to lose money on this deal. And at the time, Airbnbs were coming out. And so we said, well, there's this Airbnb thing coming out. Maybe we should try that. So we turned it into an Airbnb, and then the thing starts making us $10,000 plus per month on it. So it went from we were really excited about the deal, and then it went to a dud that we were like, oh man, this is like the worst deal ever. And then it flipped to, my goodness, this might be the best deal of our careers. We are going to make so much money on this thing. I can't believe it. We just cleared $15,000 on this last month on this deal. And the thing with Airbnbs is there's softwares out there that will tell other investors how much people are making. The first year, phenomenal. We made a lot of money. The second year, though, a lot of other investors put Airbnbs in our market that were direct competitors of ours. And what was 100% occupied turned into 90% and kept creeping down to where, my goodness, we fast forward to the next year and we're like, yeah, we were grossing a decent amount of money, but we weren't netting it because of all the expenses. And we broke even on this deal. And at that time, we started messing around with, we started really studying and doing lease purchase deals. And we're looking at the numbers and saying, man, I wish the city didn't double our taxes, because now we owe an extra $6,000 of taxes a year on this thing. It's just, everything's just messing with the profitability on this deal. And so we turned it into a lease purchase deal. And what's special about lease purchase deals is a couple things. Well, the first thing is that the repairs and maintenance go to the tenant, or at least the way we do it. You can structure it different ways, but we do it where we put the repairs and maintenance on the tenant. And the individual that we found was a doctor, and the doctor had $40,000 to put down on the property before he moved in. So we get the $40,000 down. And in a lease purchase deal, by the way, because it's a down payment, you don't owe taxes on that till they execute on their lease purchase agreement or move out of the deal, right? We got $40,000 of down payment money, and we're cash flowing this thing every single month. A couple years go by, and it's fantastic property. Interest rates have just gone up. Then what happened was he comes to us and says, "Hey, I've been in the property for 3 years now, and I would like to execute on my lease purchase agreement, cash you guys out of the deal." And we said, "Okay, well, that's cool. What interest rate are they quoting you at?" "Oh, it's like 7.5%." Our interest rate's 4% on this property, right?
because
So
you're locked in
we're
for
already locked in. So we go to him, "Well, hey, why don't we just be owner finance you the deal? We'll be your bank, and we'll give you a 7% interest rate instead of the 7.5% interest rate." It's like, "Oh, well, that sounds pretty good, but could I buy down the rate?" "Well, how much money do you have?" "Well, I have like 75 grand. Would you want me to add additional down payment money to the deal?" And we said, "Okay, well, sure." And so we end up giving him a 6.5% interest rate. He's ecstatic. His interest rate's a full point lower than what he can get on the open market. So he's winning at a huge level. And we're winning at a big level too, because now we have $110,000 of down payment money. We still own it, still are doing the deal, but we're cash flowing about 2 grand a month on it. And repairs and maintenance, he's covering, not ours. That's his responsibility, right? And so what's amazing about the lease purchase deals is there's a lot of really good win-wins that can come from it too. We have a lot of feel good stories. Helped that we are able to help a special needs family get into a school district that's really hard to get into, you name it. But yeah, so the lease purchase strategy has been an amazing thing for us because it's the opportunity to make really good money in a low risk way and have a really positive impact on the community at the same time. We have over 130 partners now, and it's just continuing to grow. And what can I say? It's an overnight success if you count 18 years of doing this.
right. Right.
Yeah,
Great, great.
yeah.
So it sounds like patience is probably the main takeaway from here.
Oh, well, yeah. Hey, so here's the deal. I myself, Jim Manning here, I did one deal my first 18 months, guys. I can't compete against some like Jim Manning that's 18 years in and that has over 30 team members in our organization, right? So don't get, if you hear people like me that are saying, hey, all these big numbers and stuff, don't get discouraged by it, get encouraged by it, and just know there's probably a decade worth of work there, or maybe in my case, almost 2 decades worth of work there to get to where this guy's at. And I mean, I can do it. If I can do it, you can do it too, but don't compare yourself to other people. It's a slippery slope.
Great. Jim, pleasure having you here. Thank you for sharing your stories. How does one find you?
Yeah, so Passive Wealth Show. If you type it into YouTube, I have a channel there. Feel free to follow me. The website, passivewealthshow.com. I have a couple free courses about generating passive income. We've generated over 10 million in passive income the last 2 years on average. And if you want to learn those strategies and what we're doing, like I have a course for that. I have a course for if you want to invest into real estate funds called Passive Profits, just kind of teaching you different strategies on doing that. And then also on that website, if you have an interest in learning more about investing in our funds, there's like a Calendly link thing that you can use. SEC requires you get to know people, right? So we have to get to know each other first, and I can kind of give you all the details there once we're in a relationship. But yeah, so passivewealthshow.com, man.
Yeah, and we'll add the links into the show notes. Thanks again, Jim.
Take care, guys.
Real estate development.